Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, February 17th, 4:56 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the Pullback Survival Edition of the Revere Market Insight video, where we take a look back at the prior week. It was a tough week in the markets. Take a look ahead at what you need to know for next week and update the world famous 21 over 21 leaders list. Let's get right into it. State of the market still in an uptrend. Didn't feel it at times, several times this week, but check over here at the trend gauge. Leaders still acting fine, giving them the green arrow. Short term also gets the green arrow, but the Dow has had two closes below the 21 now. So we got the yellow sub arrow there. Medium term, also green, yellow sub arrow, because the slope of the Dow is Dow Jones Industrial Average, the medium term 50-day moving average, is rolling over, pointing negative. Long term, we're still at neutral. We've got all five of the indexes above their long-term 200-day moving average, and trying to get the slopes of the lines turned higher. Right now, they're basically mostly flat, mid caps with a little bit of a turn up. But we need to get them turned higher to give more confidence to the market that it can survive a pullback. So what happened today? Overall, giving it a yellow arrow despite some of the the mixed close that we saw today. So we had a gap down, continuation of yesterday afternoon's sell-off as the market seemingly panicked to some comments by Fed head, not Fed head, Fed hawkish mouthpiece Bullard, talking about 50 basis point hikes, and we're going to be higher for longer. Hard sell-off continued overnight, gap down 0.5%. We were down more than that overnight. Undercut, gapped below the 21-day exponential moving average and headed lower to our next key support level lower. That was 4150 on the S&P. And it was tested 6 times today and held. So rock solid support at 4150. This is the pivot where we were before Jay Powell's dovish speech sent the market higher on February 1st. But then 2 days later, we had a strong employment report that casted doubt on the possibility of a Fed pause, and we've had strong economic data come out since then that's increased that possibility of the Fed not pausing. In fact, possible 6% terminal rate now is what we might be looking at. That's not good for stocks, and we've sold off since that Fed day on February 1st. February is a notoriously weak month for the markets, but so far just a normal pullback and leaders holding up fine. Final total for the day, G6 down 0.37%. ARC held strong all day. This is one of the things that we were keying on all day. On a day like today where we were selling off, we very easily could have seen ARC down 4 or 5%, but 2 and change was the worst it got down today and closed down only 0.38%, in line with the overall G6. That's a positive sign for the market. S&P 500 down 0.28%. We'll take a look at the action here. A lot to discuss intraday when we get to the charts. NASDAQ 100 was weak all day, but more than recovered from its lows, was down 1.8% at one point. Dow Jones Industrial Average, the leader today, positive by 0.4%. Mid caps down 0.15. Russell strong most of the day, up 0.21. Global diversified 60/40 stock and bond just barely down 0.03%. In-house, we were the laggard today. Some of our larger holdings underperformed. So the last 3 days we outperformed the S&P. Today gave that outperformance up. That's typical of growth stocks, but you don't want to panic sell just because things are going down. If there's no reason to sell something, meaning it's holding all the technical levels that it needs to, it's within your loss tolerance, then if you're selling stuff out, it's an emotional decision. This has shown me over and over again, post-trade review. that sometimes I'm too quick to get out. I battle emotions too, certainly not a robot. But we did trim a little bit today in the S&P 500 when it failed twice to get back above the 21, and then finally did clear it late in the day. So we took about 10% of our exposure off. We'll talk about that when we get to the tail of the tape and the charts, and of course the updated 21 over 21 leaders list. Let's get into it now. What do we do here at Revere Active Management? We key on what's going on in the five major indexes and how are leading stocks acting, with a focus on growth stocks, as those are the ones that can go up 40, 50, 60, 70% when you're in a strong bull market for growth stocks. So we're always looking for the next batch of growth leaders. They've got footprints that they leave on the tape and on the charts. We try to seek them out and get our capital focused in them. But below the 200-day moving average, this is the black line. This is where we spent most of 2022. We are very defensive, and the reason for that is that all bear markets take place below that 200-day moving average. This is why we want to see the slope of the line flatten out and turn up. A declining 200-day moving average when the markets are below that is the sign of an unhealthy market, a risky market, and it's one where we really want to avoid. Maximum loss last year, 27.5%. We were down less than half of that on our year-to-date returns, meaning we just need between 13 and 14% to get back to even, a lot better than being down 38% in the overall index if you wrote it the way down. And 27.5% isn't one of the severe losses. You can see those highlighted here. Those average 44.5%. And a reminder, all of these take place below the 200-day moving average. But since we got back above it, we've been dipping some toes in the water with mixed success. Trailing the indexes year to date, but we like the way the portfolio is positioned. We've got our stops in place. And if we can ride the wave, get interest rates and the dollar headed in the right direction, um, the way some of these leaders are acting, they're very buyable on pullbacks. And as long as the indexes hold up okay, we've actually had basically three levels of trading since this most recent bottom was put in. The first level is here in December between say 3750 and 3900. Then we made a higher level, 3900 to 4000. Now this level is 4000 to 4200, and we're pulling back, but still holding above the bottom of that range. 4050, a key level that represents the breakout on 2-1 after the FOMC speech. But then again, the employment report 2 days later started to stress the market, and we've been pulling back since then. But it hasn't really been impacting leading stocks as they've been undergoing normal pullbacks. The key is that they hold their pullbacks to the 21. They start breaking the 21, the indices are going to break lower. But right now, no major damage done to leaders. So let's take a look at the chart here. Here's the 5 minutes. So here's where we gap down 0.55%, put the low in 40.49. So we held 40.50 once. We tried to rally up higher, got to 40.78. This was right into the 21-day moving average, and we failed twice. So we tried to sell off again, 40.48. 1, 2, 3, 4, 5 times while we formed this cup with handle base intraday. And then finally we got above it and started to hold it instead of selling off immediately. And it closed basically right on it, a little bit above the 21-day EMA. So that's a positive. Undercut and reclaim of the 21 and a hold of this 40-50-ish area. Good stuff. We do not want to break below today's lows, or that tells us we've got a visit with 4100 coming up, or sorry, with 4000 coming up. That would be the bottom of this most recent range that we're in. And that may be a date with the 50-day moving average. This is our first undercut of the 21-day moving average in 21 days, I believe, and 30 days since the follow-through day on January 6th that kicked this all off. This that kicked this whole rally off. That was the break above the base that we formed here in late December. So that's the S&P 500 outlook. Let's go to the Nasdaq 100. Bounced at the 21 today. Good action there. It's been a relative outperformer for most of January, going sideways in February as it pulls back. Stochastics, all the stochastics have rolled over and are pointing down now. So that's a negative. But we are bouncing at the 21, holding at the 21 for all of the indexes, with the exception of the Dow, which has just been going sideways in a tight range for 3 weeks now, holding the 50-day moving average. That's the red line, but the 50-day is rolled over. 21 is rolling over, two closes below the 21. And that's the reason for the yellow arrow. The Dow actually showing some relative strength over the last 2.5 weeks. Since that employment report makes perfect sense. This is a more defensive index, and it means that while it's going sideways, while the S&P is going down and the Nasdaq is going lower, but then recall it how it underperformed during January. So, kind of playing catch up on a relative strength basis. It'll take a while for this relative strength line to get back above the price highs where it was. Normally, when you make a new high, you want that confirmed by relative strength. Certainly in stocks, not as important in indexes, but because they do go through periods of leadership and laggardship. Let's go to mid caps now, MDY. Nobody talks about the mid caps except for us here at Revere, but they're extremely important. This is the incubator for the next leaders that are going to graduate to the S&P 500, and it's holding the 21-day nicely. Second bounce there. So a little bit of relative strength this week. Stochastic pointing down, however, and small caps IWM also bounced at the 21. Stochastic rolling over. Some relative strength over the last 3 days after relative weakness for about a week and a half. But so, so 3 of the 5 indexes holding the 21 easily. The S&P undercut reclaiming, basically closing right on it. The Dow with 2 closes below, but just barely. It could very easily reclaim that early next week. Reminder, markets are closed on Tuesday. And this looks like a pretty nice cup with handle that small caps are forming. This would be the handle part of it, and it's actually has broken out of that formation on mid caps, but still putting in a handle in this pullback. So those are the major indexes. The equal weight outperformed slightly, nothing to really detail on a chart. The VIX today, with the markets being weak early, the VIX was up, but not up much, and it made lower highs and lower lows most of the day, consolidating here, really coming back into the close, which corresponded with the market going higher. Again, above, but not closing above the 50-day moving average. It's pinched between the 21 and the 50. Obviously, you know what we want to happen with the VIX here for the bulls. UUP, the dollar, started strong today, gapped up, got weaker all day. So this corresponded with what the indexes were doing. Also, let's check the daily chart on that, trending above the 21 in overbought territory. So the setup is there for this to start topping and coming lower. It can stay above. You can see back here in April, May, uh, that it stayed above for 4 weeks or so. This is the second week above for the dollar, but I'd certainly rather have this set up with us being overbought, expecting us to come down, than being at this setup with us already being oversold. So there's the dollar. Let's switch to bonds now. Bonds were higher, which means rates came down a little bit. Bonds started the day weak. You can see the gap down in bonds, and they just trudged higher all day, meaning with a gap down in price means yields started higher. So really the dollar and yields coming off benefited stocks today. There's the broad bond. Let's go to the corporate bond, LQD. Same thing, up 0.39%. So possibly a failed breakdown here. We've been going straight down for like 3 weeks. It may just be time to revert to the mean here. Note we're very oversold on bonds. So again, the setup is there for bond prices to go higher, which would bring yields down, and that's the good setup for stocks also. Junk bonds, JNK, also higher on the day. Big hammer candle there. TLT, the 30-year, also an undercut, a um, bullish reversal means lower low, higher high, bullish engulfing. So good stuff there. So let's go to the yields. We're going to expect to see a pullback in the yields here. That's what we do see. And you can see here was the date, the third, when we kicked off with the strong employment report, and then we had strong CPI data this week. That has sent yields up higher, but we're kind of at this 3.9 resistance area here on the 10-year. So a little bit extended. And again, we're overbought on yields. So the setup is there for them to come down and stocks to go lower. I'm not doing wishful thinking here. I'm presenting the facts. I obviously would love to see the market go higher, but we're presenting the facts. The market's going to do what it wants to do. We're just weighing the evidence, putting the check marks in the plus column and the minus column, and it's the weight of the evidence, and we position ourselves accordingly. Here's the 30-year higher high and then reversed to pull back a little bit today. Gold's been taking a beating today or lately. What did it do? Make a lower low and close near the top of its range. Extremely oversold on gold. Let's look back. Last time it was this oversold was here back in July, and it kicked off a rally that also coincided with a rally in the market. You don't have to rush into gold, because if it's going higher and the market's going higher, the market is going to outperform gold, historically speaking, when they're both going higher. But very oversold there, looking for the stochastic turn. How about gold stocks, GDX? Also very oversold, bounced at the 200-day moving average today. Didn't finish positive, but hey, they stopped going down. I'll bring up silver since it's the end of the week. Silver strong today, bullish engulfing there also. Um, right around this 20 area had been a resistance support line going back all the way back to May, and then prior to that, back in February, had been a key level. So we rallied off that, and we've retraced it all now. Bitcoin was strong today. BITO up 1%. Again, started weak, finished strong. Let's go to a 60-minute chart on this for some perspective. Here's the sell-off. But it's been risk on this week as opposed to the market. So Bitcoin actually leading the market. Let's bring up the QQQ the same way. They usually move in tandem, but Bitcoin showing more risk on than certainly the Nasdaq has been. So those are the major indexes. Let's flip to the tail of the tape now. A little bit longer here because it's on a Friday. VIX at 20, fear and greed unchanged at 69. AAII, the bulls dropped by about 3 points. The bears up by about 3 points this week. That's a contrarian indicator, and that's actually bullish. S&P, we didn't get the one close above. We actually got the U and R undercut and reversal. So I put that on earlier in the day in anticipation, and hey, we didn't close below it. So good for the bulls. Some news: odds increasing for a 50 basis point hike in March based on the Fed fund futures and 6% terminal rate. Which are certainly higher than were talked about at the beginning of the year. Uh, one day to a second down day. Not a bad down day, though. Second day under the ADMA, 21st day above the 21-day exponential moving average with the undercut and reclaim of it today. 30 days since the follow-through day on 1/6. Market closed on Monday. Expectations neutral coming into today with the break of 4,100 yesterday. As long as we stayed above 40.50, I'm staying neutral, meaning really won't be adding any positions unless something just completely blows me away and the indexes start acting better. But 40.50 tested 6 times intraday and held. That coincides with what the S&P and the NASDAQ did on their support levels. Here's the 5-hour cup and handle base that we discussed. Strong today, banks, XLPUV, biotech, uh, flipped by dollar and the bonds today from what they started to where they finished. Oil's weak all day today. Semiconductors and software also weak as tech lag. That's XLK. Here's our focus list. We own these. We'll discuss them when we get through the 21 over 21. Only change to the portfolio was a trim of 3.3% SPXL. That's the equivalent of 10 basis points of beta. So we dropped our beta from 1.23 to 1.13. Bottom line, productive red day, S&P holds 4056 times, undercut and reclaimed the 21-day moving average. That deserves to be in green because that's a positive for the market as we produce real time here at Revere. So let's get to the 21 over 21 list now. As usual, we'll start with the stocks that got booted. We keep these on a special list and we're always referring to them because sometimes they don't break down, they barely break down, they hold the 50-day, sometimes they break down and you want to be out of them, and 4 fits the bill for that. I believe that this breakdown yesterday, and this was an absolute leading stock, TOST reported, was down 20% yesterday. They're somehow tied to Toast, or are one is more a Square-like product, and this is just a card processor, but it certainly reacted in line with what Toast did. So 4 is Toast also. 2, you don't want to see these big volume back-to-back down days breaking the 21 and the 50. So that's the first one that kicked off. Lennar, there's been weakness with the rising interest rates in the housing stocks. Some of them are bouncing at the 50. So this is why one that we'll keep an eye on. Between the 21 and the 50, you could go down and bounce at the 50. William O'Neill's got a rule that first test of the 50-day is a re-add point for something that you're already in. So if you bought this gap up at 90, wrote it up to 109, and you're coming down here and testing the 50-day, that's an add-on point, or certainly not a sell. Now, we don't like to be in heavy in anything that's breaking the 21-day, and we never bought Lennar, but we're still going to talk about the rules as always. Las Vegas Sands starting to lag since its earnings report. Wynn has been acting much better. I mentioned that last week, and Wynn had a better week than LVS did. LVS is off. CRDO, this is just the damn shame of the week. Luckily, we weren't in it. Absolute leading stock, perfect can slim numbers, massive gap down because a huge client cut their need for their products and it lost 50%. That's just brutal. Feel very fortunate to not have been tagged by that. We very easily could have been in that stock. Shopify, weak reaction to earnings, second day follow through to the downside. That's broken, but still above the 50-day moving average. It's broken relative to the 21-day. And also, you don't like to see 2 big down days. Sometimes the first big down day puts in the bottom on a gap down, but not today. We made a lower low. So that's not good. So those are the 5 that were punted off. Let's now take a look at the official 21-21 going into next week. The first 5 are stocks that we bought this week. We're down on net, small 1% position, bounced at the 80 and held the ADMA today. I love these volume patterns. The 2 down days, way less volume than these 4, 5 up bars and big up bars before it even had its earnings gap up. Really like the setup on that. ANET pulled back, held the ADMA today. This is what we want to see in the leaders. A pullback to the ADMA is completely normal, especially with a strong move up off of an earnings report. GFS, big move up on earnings, 3 days down now. Don't like to see that, but holding the low of the gap up on its earnings report. Maybe just needed to handle with this gap up and the volume is drying up. So normal reaction sitting on the ADMA. Airbnb, we bought this yesterday or 2 days ago, added a small piece to it yesterday. Not a good day at all. This is really the biggest reason for the portfolio underperformance today, down 5.6%. Has not broken any rules though. Lower volume selling than the prior 3 days up. There's a 3.8% rule if you're and if you're a trader and looking for a good chat room, Ticker Monkey, I absolutely recommend it. I've been in there for years. There's a lot of great cancelim type studies that go on in there. 3.8% from the high volume close day is considered the average on a pullback, and we closed like right at 3.8% on the pullback from there. And I used the low of the gap day and then give it 1 to 2%. We didn't violate that either. There was a temptation to sell some of this today. We talked about it a lot in house. Reducing it just would have been an emotional move because nothing has been violated. Our total return on this is still within the minus 0.2% tolerance that we apply even to a half position, and we have 7/8 of a position in there. So still completely normal action for Airbnb. A little bit disappointing on the day. I would have liked to seen some institutions come in and support this better than they did, but there's no doubting the big volume on the prior 3 days. Next up, TBT. This is an inverse. This is a play that goes up when interest rates go up. So we had an outside negative reversal today. My plan on this is to hold it as long as it's running the 8 EMA higher. I talked about this up here. So if we continue to, I may sell it on a Stowe crossover though. As you can see here, when we had one, we peaked there. We were only above the 8 EMA for about 2 weeks. Here we're above the 8 EMA for about a week and a half. Back here, we were above it for the most part for about 8 weeks, and we had a couple of false breakdowns, but it always held. So several reasons we've got gains on this, and especially compared to the market, since basically it's a hedge. See the relative strength there. Still holding this position, 5% position in this. ALGM, big leader, just barely pulling back despite the weakness in the markets over the last week and a half. NVIDIA, completely normal pullback to the 21 after this very strong move higher. Note on a lot of these, they've been riding the 80 EMA higher. This is the first time they're coming back and testing the 21 for the first time. And again, that's completely normal behavior, such as you're seeing with American Express here. 4-day pullback on lighter volume. Mobileye, normal, excuse me, normal pullback, undercut and held the 80 EMA. This has been just a fantastic performer since its earnings report. ACLS, very strong, first undercut of the 8, holding the 21. Boeing got a stay of execution. Bone dry volume over the last 3 days. Underperformance, not today, just outperforming the market pretty much all day, and then undercut but closed right above the 21 day. So, and we own it, got a stay of execution today. ERX, this is going to be booted below the 21, sitting right on the 200. We're still holding it though, because massive support here. We're still within our loss tolerance on this 1.5% position, and massive support here at 60 corresponds to massive support at this level on the XLE. This is a 2 times XLE ETF. I got to get that one off of here. ON Semi, first break of the 80 EMA above the 21. Again, completely normal behavior. ELF holding the 80 EMA. This is a stellar performer since its earnings gap up. Dynatrace sitting right on the 21. Bros pulled back normal to the 21. AI, very volatile stock, 2-day pullback, still hasn't broken the 21. Tesla, undercut and reclaim of the 8 for the second time this week. Every time people want to send this to its an early grave, it comes back, and it did that today. RVNC, we bought this week. Perfect bounce off the 21. Love this stochastic cross. This is a great setup. A bounce off the 21 and a stochastic cross from oversold is an excellent setup, very low risk. 2% size in this one because it's on the thin side. GE continues to just plug along, not really outperforming the market much though, and 5 below doesn't even know that the market's pulling back. Look at the relative strength on this over the last week and a half. Shame, this is one I bought back here on a gap up, but look what the market was doing at the time, and it pulled back along with the market. And like a dummy, I didn't re-enter. This would have been a perfect entry point for this as the market was starting to right itself. And as a result, I get to watch it go higher for 4 weeks. We They say you can't kiss all the babies, and but sometimes when you don't kiss the one you should have, you just got to live with the regret. But the odds play out in the long run, and that's going to wrap it. That's the 21 over 21 for this week. I'm going to add a stock for 21 since we got ERX that's going to come off, and that's going to be IRDM that had a great reaction to earnings and a fantastic day two follow through with higher volume. This is extremely rare, and you got to pay attention to it when it happens. And this is going as the 21st entry on the 21 over 21 list and really needs to be monitored closely as whatever's going on there is good stuff. So what happened is pulled back after its earnings report, bounced at the 50, reclaimed the 21, big volume, and then overnight all the institutions started thinking about it. They said, we really need to get into this. And it has a bigger up day on day two and higher volume. This is an extremely rare volume signature when you have a day two higher high on volume and a day two higher high on price. Uh, it's yelling buy me. We just need a low risk entry point now for it. And that's going to wrap it. As always, love to hear from you. The email is don@revereasset.com, or my partner Dan Stewart will walk you through becoming a client. It's a couple of DocuSigns away from having downside protection and upside participation. That's growth during uptrends, protection during downtrends. That's GROTECTION. That's our flagship portfolio. Email Dan or Don at Revere Asset or call 855 Real Wealth. That's 855 732 5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. And with that, I will wrap up the week ending February 17th. Have a great 3-day weekend. Thanks for listening. Take care, everybody.